Hi everyone and welcome back to the channel. Today we are going to be diving in how to include high dividend ETFs in your portfolio while avoiding NAV erosion. Now before we start, quick disclaimer, I'm not a financial advisor and this content is always for educational purposes only. I always do your own research and consider consulting a licensed professional before making your investment decision because capital is always at risk. Now if you are chasing income from ETFs, understanding NAV erosion is crucial because that looks good on paper, might slowly eat away at your wealth if you're not careful. So let's dive into it. So what is NAV? Well, the basics of is that NAV, or net asset value, NAV represents the value, the true underlying value of the ETF and fund. It's calculated by taking the total value of all assets the fund holds, subtracting any liabilities or costs, and dividing that number by the number of shares. Think of the NAV as the real value of your investment. Behind the scenes, not just what the fund pays out in dividends. Investors often focus on the yield, but the NAV tells you what your portfolio is truly worth. So, what is NAV erosion? Well, NAV erosion happens when the value of the ETF or fund gradually declines over time, even if it continues to pay attractive income. The common causes is distribution more than the fund earns, so dipping into capital to maintain the high payouts. Covered call strategies that limit the upside potential. High fees or turnover, which slowly eats at your total returns. The result? You might enjoy impressive monthly or quarterly payouts, but the overall capital could be shrinking, reducing your long-term wealth. And NAV erosion is like having a leaky bucket. The water, which is the income, flows in, but the bucket itself is shrinking. So you always got to be watch out, be careful of that. So why is 10 to 50% yields ETFs shrink? And why maybe they extremely high yields aren't good? Well, these can often cannot sustain themselves with those payouts, especially from investments alone. To pay these dividends, they have to use capital gains or return of principal, employ aggressive option strategies like covered calls or leveraging, and take higher risk positions in less liquid markets. Take QLD, for example, which tracks the Nasdaq 100 covered calls. It pays a monthly income around 9 to 10%, but the historic NAV data shows that flat or declining capital that means investors receive income but don't see meaningful growth in the fund value. And we get to that point in a little bit. So the trade-off, income v growth. Well, high income comes at a cost, and this is why people say about the trade-off between the income and the growth is key. Higher yields often mean limited upside or capital erosion, but lower yield ETFs like the SCHD may pay less but preserve and grow your capital. Investors need to decide what do you want more, consistent high cash flow or long-term portfolio growth. But how do you spot this? How do you spot NAV erosion? Well, you need to compare the fund's NAV growth versus the benchmark indices. If the fund performs consistently, then watch out. Look at the total return versus distributions. So if distributions exceed the total return, erosion is likely. Check fees and portfolio turnover. High expenses can quietly erode capital, and track the long-term trends. Even a small 0.5% annual erosion compounds over decades. For example, an ETF paying 10% but only losing 3% NAV annually effectively nets only 7% growth before taxes. That's assuming stable markets. So, as I mentioned before, QYLD. Here's the 5-year comparison of the fund, price return versus total return. Notice how the fund pays income consistently, but NAV remains flat, but mainly declines, which is a classic NAV erosion. If you only focus on income, you could miss the hidden decline in your principal, especially when, as you can see, if we had the total return, which includes dividend and the price, we'd have actually gone up by 39.96. But actually, we won't, because the price return is actually lost by minus 24%. So if you put, let's say, £100 on QILD, you'd have actually lost £24 of that investment. Now you may, like I say, return from dividends, but you kind of want the price return and the total return going the same way. And hopefully that is the upward direction. So what are 5 high income ETFs that avoid NAV erosion. Now, I say 5, I've also mentioned SCHD. So let me just briefly go over what they are. Because the reason why I mentioned SCHD is because it's not an ultra high yield, but it's extremely popular for long-term dividend stability and quality exposure. So we got SPYI. This is the S&P 500 High Income ETF, which focuses on highly monthly income while managing the high risk that is covered call strategy. Now, the key features here is the high income focus, unlike typical S&P 500 ETFs. Covered calls on top performing stocks to generate additional cash. It's got its dividend yield, combining S&P 500 dividends and options income. And as you can see, now the price return is in the slight positive. Now, we have had a little bit of a sell-off, so it was actually up quite a bit. But the total return is up 55%, but the price return actually was going up. So, as you can see, the price return and the total return were following the same direction. And as you can see here, 1 year it was up 0.74%. It does have a dividend of monthly with a dividend rate of 12.39%. So it is actually quite good. It's a quite good ETF that doesn't really lose its value in terms of when you invest. May not be brilliant, but you're not losing your investment each year. Now, SCHD, one of the favorites in the investment community. Now, this does focus on quality and sustainability, and it does track the Dow Jones Dividend 100 Index. Unlike the ETFs that chase maximum yield, regardless of quality, SCHD employs a multi-factor screening process to prioritize financial health, dividend consistency, and sustainable growth over high-risk income strategies. And as you can see, once again, the price return and total return is up. The total return is nearly at 50%, with the price return up 25.22%. Now, as you can see, it does have a yield of only 3.3%, and it does have a $1 payout a year, so it only pays that quarterly. So dividend-wise, not great, but in a year, performance is actually up by 10%, so quite good. Now we go on to QQI, which targets the Nasdaq 100 exposure with a covered call overlay. This includes Apple, Microsoft, Amazon, Google, and it's covered calls for equity monthly payouts. The distribution is attractive for cash flow focused investors and it balances growth potential tech giants with income generation. Now, as you can see, once again, price return is in the positive. Total return in the positive. 36.86% total return, and price return is at 0.43%. Now, like I say, at this moment in time, there has been a major sell-off in tech and all that, so of course the price return will be lower, but once again, it was following in the right direction. Now, as you can see here, it does do a monthly dividend. It has at 14.79%, a dividend rate at $7.48. That's how much you'll get per share per year. As you can see, in a year's performance is actually up by 1.16%. Now, one of my favorites, and that is JEPI. And we are going to do the other one as well, JEPQ. But JEPI is one of the world's largest covered calls ETFs. They invest in large caps US equities and equity-linked notes. Low volatility, income-focused strategy. Uses covered calls to generate additional cash while protecting its NAV and actively managed designed for steady monthly income without excessive risk. Now, the price return has fallen off a little bit. It is at minus 2.89%, but the total return is at 48.41%. Now, this is one of my favorites because it is a monthly dividend, it is at 8%, and it does pay a dividend of $4.76. But I do prefer the JP Morgan ones just because of what their record is and how good they do by keeping the NAV erosion low. And following on to that, we are going to go on to JEPQ, which is actually performing better than JEPI. And it does, once again, combine high-quality US equities for options, generate strong monthly income, controls downside risk, and maintains NAV growth while offering attractive cash flow. As you can see, it does invest in the Nasdaq 100, and as you can see, price return is at 10% roughly, with total return nearly up at 66% since it started, which, whoa, is brilliant. It's amazing. And that is what you kind of want to see. But that isn't the best one overall. But as you can see, this is the stats. It's dividend rate, $6, 10% yield. It does pay monthly and it's up by 2% this year. But this is the best one, and that's DIVO. DIVO invests in quality US companies with strong fundamentals and dividends, plus an option strategy to enhance income. And it's a middle ground, good growth potential, high cash flow, and low NAV erosion. Now, as you can see, it is up 30%, nearly up 70% in total return. And as you can see, it's a monthly dividend. It only has a annual payout of just under $3, but it's a yield of 6.45%. And it's good. You know, dividend growth for 3 years, 5-year growth rate 12%, which one of the best. So I would recommend checking it out if you do want to add some monthly dividend income as well as growth, which is just a bit better than SCHD. Now, of course, if you are enjoying this video and you find this video helpful, consider supporting me with the links down below. I do post some free content on the Buy Me a Coffee page, including like free newsletters, what I'm actually going to go through for the week, what am I looking at, and I do some exclusive content as well. So if you go and click the link down below, there's a 7-day free trial that you can sign yourself up for, and you can have a look at yourself if that content is for you, without having to risk anything of your own money. And if you do enjoy it, then of course the support is optional by continuing further. But like I say, support is optional because I still do free content on there and on the YouTube channel. And also, there is links down below with Robinhood giving you a gift stock once you sign up. And big thanks to Trading212 because they were also giving a link as well where you can get over $100 worth of free stock if you sign up for now and put $1 or £1 into your account. Now, that just wraps up our guide to high dividend ETFs and how to avoid NAV erosion. Remember, high yield is very exciting, but NAV preservation and long-term growth matter just as much, if not more. You know, why would you want your investment to go down, even if you're paying really good dividends? So check out your NAV trends, compare your total returns, and focus on sustainable income strategies. If you have learned something new today, please leave a like, hit the subscribe button, and basically hit the bell as well so you know you get notifications so the videos are out for more good investing deep dives and tips and tutorials. Hope you guys enjoy, and I'll see you on the next one. Goodbye.